Hugh, I've known you for a very, very long time, and you have charted quite a course and blazed quite a trail. Are you doing this on your own terms? Is this you, Hugh Hendry, saying, I'm out, I'm done? Or is this something that was imposed upon you, do you feel?
Well, thank you. I feel like I'm kind of sitting in the cask with the Requiem and I'm sort of knocking on the inside saying I was only kidding on. But I think in terms of I don't think, correct me if I'm wrong, but I don't think there are many managers who've gone out, chosen to go out like this. You know, I had to send, sadly, the resignation letter. That's a function of economics. The costs of running a hedge fund today, both regulatory and with other commercial considerations, were just too great, finally too great. But I like to think, if you will, I died in active combat. And the whole notion of sending out, hey, here are my thoughts, here's my trade. Hey, I see the word, it's incredible, it's like that.
Okay,
you know?
I hear all that, which is why I don't believe that this is it. This is a hiatus, isn't it?
Well, you know, I've had an immense love and appetite for life, especially because it's capricious. And now I just feel that I'm better suited to deal with the random course of events, both good and bad, which will inevitably arise.
You say it wasn't meant to end like this. Are you talking about the markets? Are you talking about you? Are you talking... Well, was it meant to be like this?
Well, certainly, I mean, the last 3 months were harrowing. So myself, and I don't wish to speak for others, but my sense is that my macro cousins, if you will, we've been under the cosh. Our absolute returns have been mediocre since 2012. It's a long, long time. And therefore, there is this impetus to try and do something. And I feel generically we've been running higher levels of risk just to demonstrate that we're here and we're really trying. And I was certainly no exception to that. And I ran a lot of risk over the summer. And to my great horror, I became deeply correlated to the travails of President Trump's presidency and, of course, these geopolitical events which were sparked off in the Korean Peninsula. And I seem to be very long all of those items, not consciously, and so that certainly wasn't meant to feel to be like that.
Hugh, I hate to reduce it to something this simple, but walk me through how difficult it has been to turn from the bear that we all knew back in 2008 to essentially the bull that you are now. Walk me through that transition and how difficult it's been.
Not so difficult. There was a cathartic event for me, which was November 2013, when I published a letter borrowing from the phraseology of Entourage, the American television series. What if I was to tell you that I had turned bullish? And is that something you'd be interested in? And the resounding message from my investor base was absolutely not. Since 2013, my message has been consistently that I thought the stock market was safe-ish, if you will, and therefore the opportunity to find asymmetric trades which could... Well, there was a futility in trying to find trades that would do well in the advent of a crisis, because I could not, and indeed today, I would say to you, in the most immediate future as I peer out, I cannot foresee a crisis. But the cathartic event was saying, you know what, these central bankers, we came so close to staring down the bar of this awful deflationary crisis. They don't get enough credit. We came close to an environment where the American economy could have endured the horrors that we've seen, the travails of the Greek economy. And owing to courageous intellectual decisions, I think we've been spared that. People say, but at what cost? I would say, I don't care about the cost. There's no cost greater than preventing what could have been an immense human tragedy in the aftermath of 2008.
Hugh, why do you think it is then, over the last 5 years, I was looking at your performance and it's not drastically bad. You saw some high single-digit returns, some mid-single-digit returns, some low single-digit returns, some years of losses as well. Why do you think it is that investors kind of abandoned you and we took this AUM from billions to literally 30 million?
Well, so I have now, I've clocked up the best part of 15 years of performance. And so I can now say definitively that we compounded at 6% per annum on average, if you will, over the course of that journey. You have to look at it in terms of what I was doing. I was really a macro portfolio and therefore a diversifier to funds. And my correlation was very tight to volatility. When volatility spiked, as we saw in 2008, famously for me and whatever, I made this very good profit, if you will. But by and large, over the course of that time, volatility volatility has been low. So if you will, I have offered a positive carry of 6% whilst allowing the majority of my clients to be long volatility and therefore diversifying portfolios. I am not your competition. If you're managing a portfolio on your own, I congratulate you and I wish you the best success. But I am absolutely curtailed, if you will, in what I can and cannot do. My role is to diversify your risk portfolio.
Is that model bust?
I fear we have to change the expectations for that model. So my understanding of the global macro model, it was very much that it very much came from a fixed income universe. And I've been trying to articulate the notion of a debate between debtors and creditors from the people with the folks with lots of money who provide the capital to the geniuses and the entrepreneurs who go out and create income and create jobs and push the economy forward. And my argument has been for the last 3 decades, capriciously or otherwise, we have over-rewarded the rich folk. And therefore that would manifest itself in very high real rates of return from US Treasury bonds. And so the return versus equities in nominal terms didn't seem very high, but a global macro fund could come in and leverage those fixed income returns and get a very high risk-adjusted return, which would cover the expenses of running a hedge fund and would cover the expenses of having negative bets like puts on the S&P. And occasionally, again, these puts would become very rich, and it would just add to the rock star notion that these guys could walk on water. This is why we saw huge allocations to this sector. Today, I think, I would estimate that real 10-year US Treasury returns today are 0.3%. The notion of leveraging what seems to be a fully valued asset, really, do you really want to do that? And even if you do, the returns are not that great, and certainly not to cover the increasing regulatory burden and the expense of running a global macro portfolio, and certainly not to cover the negative carry of these convex but sort of risk protecting.
I'll take this as a yes. The model is broken, right?
Yeah, it's broken. So we have to look upon global macro today as a cost center. It can, and I think there's a valid role for it in diversifying portfolios. I think the great vulnerability to everyone's wealth today is that we're depending on what has been a negative correlation with US Treasuries or government G7 bonds with stock markets. When stock markets have been hit the skids, you've been thankful for your government bonds. Today, they're not priced to protect you. So if clients are willing to underwrite losses until we see the skids, if you will, then it has a role. But of course, it has a role with a lower and lower allocation of risk capital from clients.
Hugh, everyone's trying to find an economic framework for thinking about financial markets at the moment, and you offer one off, and you don't think about the 2000s, you're not thinking about the 90s or the 80s, you're thinking about the middle of the 1960s and what happens next. Why is the 1960s so relevant to what's happening now and how you think this is going to evolve?
For a moment there, I thought you were going to say the 16th century, because 1964 and 65 may as well, in terms of the dog lives of our markets. It seems an extraordinarily long time back. Why? 4.5% national unemployment rate in the US. We have been here 3 times. I would dismiss 2 of the last occasions coincided with the TMT bust and the housing bust of 2005, 2006. These were moments in time where there had been immense credit excess in the American economy, which is to say that the American economy was very vulnerable to a Federal Reserve that hiked interest rates. In 1964-65, we did not have that. Again, we had a labour market which was as tight as we see today, but there was nothing that threatened the economy from being knocked over if the Fed raised interest rates. And what we discovered was that the Fed was slow. The Fed today is certainly not in any hurry. And markets, and what's remarkable today, the monkey brain of the capital markets, having sort of said, I hate you, I love you, I hate you, I hate you, I love you. They're now saying, we want loose policy. Stay loose. The markets today are only anticipating 25 basis point hike between now and the end of 2018. That's just, I feel, it is, if there's a culpability, both the Fed and I think capital markets should have the resolve to push for tightness. They're not doing so. And in 1964-65, in similar situation, inflation just steadily picked up. And the mechanism is when you get wage hikes, it becomes QE plus wage hikes is Bernanke's helicopter drop. You are giving money to people who are going to spend it. The QE of the 2009-2012 vintage was giving money to rich folk who had no desire to spend it. With wage gains, you go into a world in which Bernanke's predecessors, they never had the guts to go full-on helicopter. That's where we are. And in 1965, we saw 30 years where the US inflation rate did not dip below 2%. Could it repeat itself?
So, Hugh, here's the question. I'm going to offer up the hedge fund dream. Your investor base has the patience of a saint. Your AUM is about £1 billion sterling. If you could put that money back to work now, over the next 5 years, how would you be thinking about markets?
Indeed. Okay, well, I tell you, I mean, today, and indeed, the good thing today is, I believe that there's a lot of good things today. We now are witnessing synchronized economic growth across the world. You know, Europe is picked off the floor. It's growing. China is like just full cylinder, and the American economy refuses to go into recession. Okay, that's good news. It's good news for equities. It's good news for commodities. They already know that. They've picked themselves off the floor. I think they'll continue to trend. Again, because of this kind of monkey brain, I hate you, I love you, I think capital markets want to keep US Treasuries bounded between 2 and 3%. And they're not going to do anything to precipitate a crisis. And there are no underlying credit bubbles. That's great news. The only bad thing is, inevitably there will be an air pocket. And where's your protection? So in protection terms, I just think the most distorted asset class in the world is the 2-year German bond, or the Schatz as it's named. I'd be short that. It's people are willing to lose 75 basis points a year for security. You know what? You don't need that security. It's the wrong price. Secondly, where we have had a credit excess is China. Will China bust? I have absolutely no idea. Should you be worried about it? I believe you should be. Should you have protection? I believe you should be. But that protection should be very, very cheap. Today, you can make any China risk disappear at almost zero carry. It's very boring, but it exists. Trust me, I used to be a macro hedge fund manager.
On that note, we started off talking about whether this was a hiatus or not. Let me kind of just extrapolate a little bit on John's question. What model does work? What model would work? If this is a hiatus, that Hendry will be back, and I find it hard to believe that you won't go away and rebuild the house in St. Bart's and have a rethink. What is the model? How does a manager approach a business? How do you recreate or create something that is a functioning story to run money that has sustainability now? What does it look like?
I have absolutely no idea.
There's nothing out there that works. There's nothing out there that you think that's got legs right now as you look at what's going to happen going forward.
But you're confusing me with someone else, right? I am just the artist guy. I'm the guy you want some ideas and provocation. I'm not the guy who does the plumbing. I'm very bad at the plumbing. Okay. But I would say, however, so I don't want to offer kind of corporate responses for the hedge fund community. I've offered one which is really, and the ideal situation would be finding a client base that would be willing to underwrite losses. Okay? They would be saying, I want you to lose at least 5%, no more than 10, but 5% a year. I think you're doing your job. Okay? That would be a dream. What I want to say is that, again, for investors today, there's a lot of good news. Enjoy it. Enjoy it. And again, it will come to pass. And when it comes to pass, people will be saying, where are the macro hedge funds? And
precisely, this is my point.
Sorry, guys, you kind of
you put us out of business.
Yeah, which is, hey, look, I have cosmic karma with that. That's.
Hey, Hugh, just to wrap things up, from Glasgow to the City of London, it was always kind of well known that you weren't quite a city boy. You didn't quite like London. What's your message now? You're departing and leaving the hedge fund world behind. Yeah,
I don't know what gave you the impression that I wasn't part of the finance clan. My point has always been I've been very good at being idle. Sitting in front of unnamed terminals for 10, 12 hours a day may be good as you kind of try and justify what you're doing, but I don't think it's been very good for ideas and radical ideas. I think some of the best ideas we have is when the mind relaxes, when we do other activities. So I think if I've succeeded at anything, I've succeeded at being idle.